Everyone is looking for a quick and easy way to become rich and happy. It seems to be human nature to constantly search for a hidden key or some esoteric bit of knowledge that suddenly leads to a winning lottery ticket. While some people do buy winning lottery tickets or a common stock that quadruples or more in a year, in this video, we're going to discuss 7 simple strategies and things you need to know about investing in stocks. Number 7. Never jump blindly into the stock markets. Many a times it happens that while talking to your friends and colleagues, the discussion heads towards the stock market and also how the stock market helps investors make big money. You might never have invested in the stock market, but after hearing about all those things, you decide to buy some stocks. However, if you entered the market just to remain in the mainstream fashion, you landed in for the wrong reason. You should invest in the stock market after getting the basic knowledge about it and in accordance with your financial goals. While stocks are often viewed as a safe investment strategy in the long term, nothing is guaranteed. Before you get started, you should understand basic principles and laws of economics. The stock market closely follows the law of supply and demand. The stock market is volatile, especially in the short term, and can swing wildly in between extremes. If you're looking to invest your money in the short term, there's usually much more reliable, low-risk investment strategies available. The stock market has historically grown at an average of about 7% per year. From year to year, however, the stock market can experience dramatic highs and lows. Even over a short period, return on investment in the stock market is never guaranteed. Remember that ignorance is expensive. That's why knowledge is and always will be the best investment. Learn more and keep learning. Learn for life, and you'll never be poor. Number 6. Select companies with staying power. There are so many companies that exist in today's stock market. Selecting becomes a major decision for beginning investors. Relatively stable companies and businesses are owned by the government, unless there's a political revolution or crisis going on. Gasoline companies and telecommunication companies are usually profitable and stable because there's a constant demand for their services and products. While IT companies are rapidly growing in today's stock market, there are so many of them it may be a challenge to check their profiles to exercise reasonable care before investing. Before putting money into an IT company, verify their track record and make sure they're stable and profitable for a minimum of 10 years. When you watch the news, make sure to keep track of the industry your company is in. Even stable companies may go bankrupt or have a major blow that'll bring them down. Number 5. Set long-term goals. Why are you considering investing in the stock market? Will you need your cash back in 6 months, a year, 5 years, or longer? Are you saving for retirement, for future college expenses, to purchase a home, or to buy an estate to leave to your beneficiaries? Before investing, you should know your purpose and the likely time in the future you may have need of the funds. If you're likely to need your investment return within a few years, consider another investment. The stock market, with its volatility, provides no certainty that all of your capital will be available when you need it. Remember that growth of your portfolio depends on 3 interdependent factors: the capital you invest, the amount of net annual earnings on your capital, and the number of years or period of your investment. Ideally, you should start saving as soon as possible. Save as much as you can and receive the highest return possible consistent. Many believe that the stock market is like a money-making machine, which can turn them into millionaires over a period of time. Well, it is true that a lot of investors have made profits through the stock market, but it was only possible because they have good market knowledge, made some really smart choices by adopting carefully thought-of strategies, and are also much disciplined in their approach. Many people forget that a lot of people have lost their entire wealth, while some have been forced to sell their personal assets to cover the loss in the market. Number 4. Diversify your investments. Experienced investors such as Buffett eschew stock diversification in the confidence that they've performed all of the necessary research to identify and quantify their risk. They are also comfortable that they can identify any potential perils that will endanger their position and will be able to liquidate their investments before taking a catastrophic loss. Andrew Carnegie is reputed to have said, "The safest investment strategy is to never put all of your eggs in one basket." That said, do not make the mistake of thinking you are either Buffett or Carnegie, especially in the first years of investing. The popular way to manage risk is to diversify your exposure. Prudent investors own stocks of different companies in different industries, sometimes in different countries. with the expectation that a single bad event will not affect all of their holdings, or will otherwise affect them to different degrees. There's no way of reliably predicting which companies will be an overnight success. If you guess wrong, you may lose some or all of your investment. Also, avoid over-diversification, as increase in the number of stocks up to a certain limit do help in diversifying the risk proportionately. But beyond a certain number of stocks, your investment can't get the proper growth. Number 3. Avoid leverage. Leverage simply means the use of borrowed money to execute your stock market strategy. In a margin account, banks and brokerage firms can loan money to buy stocks, usually 50% of the purchase value. In other words, if you wanted to buy 100 shares of stock trading at $100 for a total cost of $10,000, your brokerage firm could loan you $5,000 to complete the purchase. The use of borrowed money levers or exaggerates the result of the price movement. Suppose the stock moves to $200 a share and you sell it. If you had used your own money exclusively, your return would be 100% on your investment. If you borrowed $5,000 to buy stock and sold it at $200 per share, your return would be 300% after repaying the $5,000 loan and excluding the cost of interest paid to the broker. When you borrow money to invest in stocks, you're inviting another person or institution which may not have your best interest at heart into the decision-making process. Leverage is a tool, neither good nor bad. However, it is a tool best used after you gain experience and confidence in your decision-making abilities. Limit your risk when you're starting out to ensure you can profit over the long term. Number 2. Invest only your surplus funds. The biggest mistake newbie investors make is to invest money that they can't actually afford to lose. Investing in the stock market is risky, and that means that you can potentially lose everything. Like any investment, there are inherent risks associated with the stock market. Some risks are related to the overall market, a systemic risk that you can't avoid by diversifying your portfolio, while some risks are stock-specific that you can avoid. You need to decide your own risk tolerance, considering your age, financial strength, retirement goal, etc., and should take the risk accordingly. If you want to take risk in the stock market, then only invest your surplus funds, which you can afford to lose. Investment is done to generate more money, but do not invest all your emergency funds in the stock market. Hoping for the best from your investment is not wrong. But you could be headed for trouble if your financial goals are based on unrealistic assumptions. Number 1. The stock market really isn't scary. The worst thing that can happen in the stock market is that it can crash. But we've already established the fact, first off, that it will go back up inevitably. The only reason why the stock market sounds or feels scary is because you don't know enough about it. Get educated and understand the terms, and you'll soon realize that what you feared was just the things you didn't know. If you knew the stock market like the back of your hand, you'll know there's absolutely nothing scary about it. Yes, it's true, the market crashes from time to time. It also sees a lot of dips and falls, but equally, the market sees enough ups to keep investors going. Even more, each time the market has fallen throughout history, it's gotten right back up and even stronger than before it fell. It's all a matter of physics after all. Anything that comes up must come down. And when you're down, there's no other way but up. It may be true that regulations can't protect everyone. That said, regulations do protect a lot of people and their money on a daily basis. You can't let a bad seed ruin the entire tree for you. The truth is, a lot of people make money from the stock market by being informed and following regulations. Regulations will not only protect you from others, but they will also protect others from you. They're there for everyone's benefit. Get rid of the fear and greed cycle. Do not invest in any speculative, unknown stock lured by its past fabulous return, without understanding the risk involved that will lead you to suffer loss. In a bear market, control your fear and don't panic and sell shares at rock-bottom prices. Thus, fear and greed are the worst emotions to feel when investing, and it is better not to be guided by them. We hope that knowing these things will help you immensely. Do let us know if you've ever invested in stocks or want to invest. Please subscribe to The Luxury World. Thank you for watching.